Hello and welcome to DigFin Vox, Voices in Digital Finance. I'm your host, James DiBiasio. If you enjoy the program, give us a like, share, subscribe. Trading comes at a cost. Brokerage costs, clearing costs, exchange costs. How does the sell side deal with all of this? Because it's complex, but there's increasing ways to use automation to try to deliver visibility to COOs and CFOs. With me to talk about this is Bharat Malesha, Executive Vice President for Fees and Expenses at SmartStream Technologies. Bharat Malesha, welcome to DigFin Vox.
Thank you, Jim.
We're going to talk today about fees and expenses, which obviously when times get difficult in financial services, people tend to focus a little bit more on.
Just as a way of introduction, my name is Bharat Malesha. I've been with SmartStream for over 8 years. I came over to SmartStream as part of an acquisition of the product and services around fees and expense management. So I've been associated with, when I talk about fees and expense management, for over 15 years. Now, let me explain what fees and expense management means to us. It is a process of controlling the market-facing costs associated with executions. So these costs mainly consist of brokerage fees, clearing, exchange fees, regulatory fees, settlement, and custody fees. So all these
yeah. And so, Brad, just so I understand that the kinds of institutions that are paying these fees are brokers with seats on exchanges. Is it just equities? Who are we talking about? Is it hedge funds? Who has to pay this stuff?
So these fees are paid by sell-side firms to various brokers, exchanges, clearing houses, custodians, CSDs or ICSDs, and they're paying these fees to them. Now, if you look at banks spend, like when I'm talking about banks, the sell-side firms are spending hundreds of millions of dollars annually in these market-facing fees. Again, which we typically also call as BC&E, is brokerage, clearing, and exchange as an overall umbrella. Again, this is the second largest spend base in the non-compensation category. So if you look at any of these tier 1, tier 2, tier 3 banks, you can see that these are the very large expenses on their P&L when it comes to non-comp expenses. And I think the banks and other financial institutes normally contend with very high regulatory costs. They have pretty high capital requirements. And I think they're continuously under pressure of on ROIs. And these firms really require to kind of closely monitor the internal trade costs across front to back office and all of their technology functions, including communications and things like that.
Right.
So I think banks really need a level of metric of these spends to really make some kind of efficient decisions or more data-driven decisions.
Bharat, you've been in this 15 years. You've been specializing in this area. That's a lot of expertise. What's different today versus when you started out?
So when we started out, I don't believe firms had a real strategy or banks had real strategy around managing these costs. As the evolution of as the volumes of trading have gone up significantly over this period of time, there has been more and more focus on these costs, because with compressed margins and the spreads sort of narrowing down, the focus is come back to cost and saying, are they really making money on certain transactions or not? And that's the decision they have to make. So I think, again, coming to having that metric of cost put on every trade is absolutely essential for banks to make decisions on which products, which customers, and are truly having a return on their bottom line, right?
Yeah.
So what is happening is it's really very important for CEOs and CFOs and the business managers or desk heads to really understand that cost in the basis in order to properly kind of price their business. They need to be able to measure their profitability. They need to look at their business lines by client and really enable them to kind of explain the differences between what they're forecasting versus what the actual business performance is, and really assess the return on their investments.
Right. How has that also changed with, in that period of time, much of trading has become automated or electronic? We've gone from voice and the traditional sort of sales trading led floor to something that's much more quant, a lot more low touch. Start first in equities, now much more in fixed income, FX. So as that's happening, what's happening on the fee side? So are they able to, and volumes, of course, are much greater. So yes, maybe fees are higher, but is that just a reflection of much more activity? And, when you do that, as you mentioned,
Absolutely.
How worth it is this trade? Is that been fairly stable, or has there been real changes in the how worth it is to do this trade based on the cost of it?
That's I think one of the key drivers. As trading volumes have increased, the size of those trades have become smaller, and like the unit cost of those trades have sort of, even if the unit cost from OTC to electronic has reduced significantly, but still the spreads on those trades have actually those execution have reduced. Where you used to do, let's say, 100,000 transactions, those same firms are now running about 5 million transactions a day, and that is because of the size of what, as you said, algos running through, the strategies that they're running through, and each of them, these are all different cost drivers that define the cost of that particular execution. So how efficiently they're actually executing from a cost standpoint also need to be monitored very closely. I think what is happening is that these head of trading or COOs, they must determine whether the businesses and customers really generate adequate return on capital. And to do that, they have to understand that cost at that level. And just not having, so just where you take out the costs as an aggregate across businesses and geographies, I think they need to understand what the challenges in each of those geographies are, and each of those jurisdiction or those markets are, to understand what that cost basis is to kind of really drive efficiency.
So you sort of have a matrix. You've got obviously product, or let's say asset class. You have marketplace, right? I guess is different in Hong Kong versus is in India versus Australia. And then you've also got the fact that you're dealing with brokerage fees versus clearing versus exchange. So you got kind of this three-way matrix to kind of figure out what it's going to cost you to do a certain activity.
Yeah, when we talk about BC&E as overall at the top level as three three key pillars of those expenses, but underneath there are several subcategories of these costs, and that apply in different markets, different situations, different type of execution, including if you look at transaction taxes. So they are prevalent in France or Italy, or or on the Spanish markets. They have a transaction cost of executing any securities within that kind of domicile within those countries. And you can see these regulation, whether it's stamp tax, whether it's Section 31 fees, all these combined fall into within these categories.
Right. Yeah. So some of these costs are fixed. Like in Hong Kong, we've got a stamp duty on equity trades. So I guess to some extent that cannot be. Maybe you can automate the processing of that, but you can't get rid of that cost.
No, it's not only always about optimizing the cost, right? It's about bringing transparency of that cost and what's drive that cost, and how do you allocate that cost back so that it's actually following the revenue, and you're able to kind of look at the overall net contribution of every execution that is flowing through. So I think firms when I look at various firms across the globe, they're looking for almost a near real-time view of their BC&E costs. It is not just sufficient to answer how much is the cost or what is their spend base, but is also to understand what is driving that cost. It needs to explain the change that happens period over period. Is it because of certain strategies they are running? Is it because of the price change? Is it because of their volume change? So they are looking for a strategy to really come up with a consolidated reporting around the overall spend base, so they can get some key insights and measurements that they really need to drive a more informed business decision.
Bharat, another big trend we've seen that's, I think, now played itself out, but has had a big impact on the industry was the unbundling of research, right? So that created, I guess, new pressures on understanding what things are valued and what they cost to produce. Does that also play into what you're doing? Because obviously you're not trying to price research, but on the execution side, that left a different kind of dynamic.
No, so we actually do split research and execution costs for many of our firms.
Okay.
Because what happens is there is an agreement on what that research cost is going to look like per transaction or based on that volume, on a volume adjusted basis. It's actually created, and the pool is created to pay the research vendor against that kind of the pot that has been created for research. And then you have a separate execution cost that is sort of reported separately. So firms are looking at doing that, and it's pretty common to have that understanding of that research cost. What you're kind of basically creating a pool for your clients, and how clients are using that research through these research providers, and then actually pay those bills out on behalf of your customers. So that's also critical in this whole process.
Okay, so that's part of the game. How has automation changed in that time as the trading has become more electronic? Have the ways to capture and account for what's happening also become more automated?
It has significantly automated, but again, it depends on the different markets as to what the level of automation, certain markets kind of provide. I'll give you an example that around the globe, there are only a few number of markets that actually provide digital fee schedules or publish digital fee schedules. In most cases, they are in PDF, Word documents on their websites. And it is a contract which is like hundreds of pages sometimes, or tens of pages of that, these fee schedules. So there is a need to sort of understand what that flow of those transactions is, and what that kind of fee means, what the tiering are, what different plans are, and digitizing all that information is also a big challenge today in the industry. So that's one of the areas that we kind of focus with our customers, that we support our customers as a utility to provide that sort of a digitization of all the fee schedule, digitization of all the invoices, because invoices don't come in electronic form. They're again PDFs, and they're more machine readable because you can get an Excel, and they're more machine readable than kind of others. But there's always that challenge. It's not something completely kind of standardized or message based like any of the ISO messages and things like that.
Right. So do you deploy a lot of artificial intelligence or machine learning to try to decipher these texts?
So one of the areas that we've been focusing on is in actually digitization of the invoices, because there's key information on the invoices at the level of that we want to capture those invoices today is extremely important. So when you asked me earlier about what has changed, so 15 years ago, when we get all these invoices, they would be in PDF forms or Word forms or scanned documents. It would go to an accounts payable team. They would basically get an allocation from the business and get a high level view of saying, okay, it is in line with their previous month or the last 3 months average, and pay those invoices. But there was absolutely no transparency captured from those kind of that information and saying what is actually driving that cost, because everything was at a vendor level, currency, and legal entity. That's pretty much it. But now we're able to dig down deeper on every line item, every service that these vendors are providing, and we're able to kind of capture the volume and the fee associated with that to kind of drive that kind of a business intelligence in that spend base. So again, I think it's important to understand that because of that, firms are looking for enablement, right? They're looking for enablement of various businesses that they're offering. I'll give you an example of that is a cost plus offering that our customers want to do. To offer their clients cost plus, they have to really have a clear understanding of their cost base at execution level. There is no other way of actually saying, you can give them cost plus. So because you need to understand the cost, and that's what you're passing on to the customer.
How
So it's
different
extremely important.
Yeah. How different are those experience with your customers in, say, developed markets versus emerging markets?
I mean, again, just to tell you, the fact is that every market has its own nuances and differences. Asia markets or European markets are more complex because, again, there are many more exchanges, there are many more clearing avenues, and multi-currency. Right? Unlike US, it's one currency, one major clearing house, or two major clearing houses, and two major custodians, let's say, or CSDs.
Right.
But then when you go into the European market, you have now you're swallowed with a slew of clearing houses, different currencies, different markets, and trading happening on exchange on markets in multiple currencies. So it creates that complexity, and that makes it even worse in Asia with those volumes and the complexity of those and the nature of those jurisdictions in terms of how they operate and how they charge fees on these transactions.
What is the way that COOs or CFOs can use this information not just to maybe be a little more efficient in their trading strategies to figure out, maybe they decrease high cost transactions, but how much information can they get about the overall operation from looking at fees and expenses? What kind of power does that give them?
So I'll give you an example. It's giving them an empowerment into visibility to what markets, how they're getting charged for certain strategies.
Mm-hmm.
So whether certain strategies are going to work in one market versus the other, there are options available to them, and they are able to drive that optimization. They're able to drive the plans that they sign up with these markets. So many markets actually even offer different pricing models. And whether you take pricing model A versus pricing model B, for your volume profile, how do you align that? So it's the analysis that needs to be done as to what your effective rate ultimately is across each plans, and then choose the best. And if they could be making that decision month over month, subscribing to a different plan to take that optimization. So it's not just about the quality of execution, because that they cannot change, but they can definitely make decisions on what is going to cost them, from a costing standpoint of those execution, what works best for them. There are various incentive plans these markets offer. Are they aware of those incentive plans? Those incentive plans keep coming month over month. Are they subscribing to those incentive plans to really take the most optimized way of execution in those markets?
What's the challenge for you as a business in terms of getting? I mean, we can talk at a high level about some of the big trends that are happening and some of the ideally what you'd be able to deliver to banks. Yeah, they have to deal with a lot of systems. They have to deal with a lot of questions, integration.
So firms work right now in a pretty complex environment, right? So you have legal entities and different businesses, different regions, different jurisdictions. Now what happened, and all these fees, as they again, it gets pretty complex in terms of how that the charging mechanism happened, or how do you arrive at that cost base? Because even firms like these providers, like these markets or these venues, are also trying to optimize their revenue at the end of the day. So they make these as complex as possible to ensure that they're also getting enough revenue out of that, and then not losing revenue or market share within this space. So part of the challenge again is always with these firms is the complexity of this. As I explained, there are multiple sources of information. They have several execution platforms. They have several booking platforms. They have several settlement platforms. Now, sourcing that data, getting the right attribution required to drive that will basically be able to get a correct value of what that cost should be, or more, get an accurate view of that cost to be able to be calculated. I don't think that's their focus when you're talking about trading platforms or booking platforms. So that integration is a big challenge. The data quality that comes out, the enrichment of that information. just to deal with that, it becomes pretty challenging within banks. So I think it's just not like, it's just not as simple as saying this is one project, but there's
Right.
all these other integration points where the cost kind of, comes in to implement that. So there's always this entry point barrier, right? I would say a barrier to entry into
Yeah.
this kind of objectives. But I think firms who have clearly defined a strategy and saying how they want to move that, and they have very specific strategic goals on what their cost efficiency should look like in this space over the next 3 years, over the next 5 years, are really adapting to this kind of, this message.
How
So
do you,
I think,
I mean, I guess if the banks, they're running a zillion things are happening at the same time. So two big trends that are, I guess, sort of still ongoing. One is the Libor shift to new benchmarks in the fixed income world for interest rates, or in the equities world, the US is feeling its way to going to a T+1 settlement time. So when you've got these big global mega trends happening in capital markets, they need to make those changes, but they need to make sure that ideally that as they make those changes, that they're doing so in a way that keeps them kind of future-proofed or forward-looking. So how do you kind of insert yourself into that conversation?
so the fun thing is, I've worked at a bank for 20 plus years, and the challenges within the bank is there's always only so much budget for these large projects, and so always only so much budget for change the bank. And what happens is when you have these mega trends driving most of the sort of projects, this piece of fees and expense management sort of, almost overlooked at times, right? And saying that it's not a mandatory kind of, requirement. As long as you're able to kind of manage and pay those and have some controls around these processes, you're fine. So you're focused on kind of driving those big events that are happening in the market, and all the investments drive there. Or there are regulatory focuses that come in, and a significant budget goes out there. So that's where I think it's all about at the end of the day as to what you can produce for what you kind of have from a budgeting standpoint to change the bank, and that's what drives that kind of the cost basis. I'll give you an example. When we talk about T+1, but when they're looking at that from way I look at it is, this is going to increase the volume significantly. Mm-hmm. Because now you have less fail rate, less capital requirement. If all that fits in together, that means there'll be more trading happening, because now you would be able to use those funds to trade more. Right. So that means your trading volume could potentially double. But with that, there's also a cost associated, and who's looking at that? What is the cost basis of doing that? And that's where I think people need to start looking at things, and more strategically in terms of how they manage this cost.
One last question for you, Bharat, and thanks so much for your time today. Crystal ball, you've been in this game for a while. You work for SmartStream, a technology company. Where do you see the tech headed in the next several years?
I think there'll be more digitization. There'll be more, there's absolutely going to be changing the overall automation landscape. There will be more predictive analysis that will be coming in with kind of, having all the AI, ML kind of, technologies that are going to push this thing. And I think there'll be a marketplace where there'll be a much more electronic focused marketplace. But I think it's also then going to increase the scope and the volumes of what is coming through. Right. So I don't see the cost going away anywhere, but it's going to be transformed in many different ways. So I believe that the processes will be required, the controls will be required, but a lot of that will be driven by sort of this automation. But then to handle those volumes, that automation is required. Because with the current scale of where the automation stands today versus labor intensive work, that is going to be replaced by kind of higher volumes, basically.
Yeah. Well, I think we'll end on that note. I mean, at the end of the day, those higher costs reflect a good problem, a problem you want to have, which is more business and more activity. It's just how you manage the inevitable downsides of those. So Bharat Malesha, thank you so much for taking time to speak with me at DigFin Vox.
Thank you, James. Thank you very much.